What I used to even say to certain prospects and certain clients, and if I didn't say it to them, I did it. I'm going to teach you how to be a good client. I'm going to teach you what to do, how to act, so you're a successful client. And if I can't do that, you shouldn't be a client. It's not a good match. You have to learn how to turn people away.
Hey everybody, welcome back to another episode of The Connected Advisor. I'm your host, Kyle Van Pelt, co-founder and CEO of Milemarker. And today I am joined by Pat Sweeny. Pat is the chairman and CEO of Apella Wealth. He was also a co-founder of Symmetry Partners. And I love this, he is a frustrated golfer and a loving grandfather, which I totally want to dig into a little bit as we get into who Pat is behind the CEO of Apella Wealth. But you've done some great things in the industry. I'm looking forward to the conversation today. Thanks so much for coming on.
No, me too, Kyle. Thanks for having me.
Absolutely. So Pat, I start every one of these off the same way, and this is going to be no different. I found that everybody has their own unique path to our industry. Some of those paths are traditional, like they followed in family footsteps. Some people's are very non-traditional. They came from, all types of different backgrounds. But what I've found is whether your path is traditional or non-traditional, everybody had what we call a money moment. It was a moment in their life that made a light bulb go off where they said, this is what I want to do for my career. This is how I want to serve people. This is what I want to do. So Pat, for you, what was that money moment that put you on the path to the seat you're sitting in right now?
It's actually easy to look back on that time and give you that answer. It wasn't a moment. It happened over probably a span of maybe several months up to a year. I spent about 10 years in the industry on the institutional side, trading commodities, bonds, stocks over about a decade. I was in downtown New York. It was a family business. My dad and my sister both preceded me into the business. I wasn't sure I wanted to be in the business, but coming out of college, like a lot of us, I didn't know what I wanted to do. I learned a lot. I learned a lot about markets. I learned what not to do for clients because, as you know, the industry is a rough and tumble industry. I met a lot of good people, though, and I learned a lot. But the moment that you're looking for happened after I decided to leave institutional and go retail. Perhaps naively, I came to the realization that retail investors, moms and pops, had no idea. In aggregate, they had no idea how markets worked. They had no idea how they were being sold products as opposed to receiving financial advice. My father, who was a school teacher before he went to work on Wall Street, another one of my sisters was a school teacher. It seems to be in our family. It came very naturally to me to teach these people about how markets worked. And that was my moment when I said, this is what I enjoy doing. This is what I appear to be good at. This is what I'm going to continue to do.
We're going to dig into that a little bit because I do think that having the heart of a teacher is such an important part of being successful in this industry. But I don't know why this question just popped into my head as you were answering that. But I think a lot of people have this notion that working with the institutional clients is almost like getting on Easy Street. Like, oh, great. You go end up with a couple pension funds, a couple endowments. Like that's what everybody wants, right? You got sophisticated investors and they've got tons of money. So fewer clients, high AUM, like that's great. Everybody would want to do that rather than work with retail clients. Is that a big misconception or, do you want to debunk that a little bit? What are your thoughts there?
From my experience, and now I've been out of the institutional side a long time, but I don't think this much has changed. They are sophisticated when you're talking, and I was young when I was on the street, so I was talking to people with more experience than I was on the other side, on the buy side. But I would tell you that that money is not sticky. That money is what have you done for me lately? And it can move. It's very mobile. Retail, as I've found, and that you're probably aware of, is much stickier money because you're delving into a person's life. I think if you're doing it right, you're delving into their life above and beyond investing. Our firm focuses a great deal on financial planning. We're deep financial planners. We'll talk about that later, I'm sure. But I think the retail side of the business allows you to build a relationship far more in depth, far stickier than the institutional side.
Well stated. Well stated indeed. So you were co-founder of Symmetry Partners, which is a pretty household name in the space for any folks who've been around for a little bit. But now you're kind of on somewhat of your second act, I would call it, with Apella or whatever. Talk to us about, the run at Symmetry, but then kind of what you saw that you wanted to do differently at Apella or when you came back the second time, like what you wanted to do with the blank canvas.
Sure. So the interesting thing is that Apella is actually the precursor to Symmetry. My partner and I left, here's a name from the past, left Dean Witter back in the early 90s, 1993, because we thought we could do a better job for our clients. D. Witter was a fine firm, but it had a way of doing things, creating product and moving it out the door. And we didn't want to work with our clients that way. So we were certainly not the first ones to do this, but we were early on we started a fee-only RIA focused on doing financial planning and investing in a way that I had been learning about while I was on the street and the institutional side. I had read Bogle on mutual funds, kind of changed the way I thought. That referenced A Random Walk Down Wall Street by Malkiel, which also referenced the work of Gene Fama. So that informed us on how we wanted to invest money, and we already knew how we wanted to work with clients. And so we were a direct to the consumer financial planning shop initially. The first 7 years of Symmetry is what we did. That's what we did. And literally an advisor from another firm in our town came to us and said, I want to learn what you're doing. It's very different than what we're doing he was at an independent broker dealer. Very quickly, a number of advisors at that firm started wanting to learn what we were doing. And Symmetry made a pivot at that time to a TAMP-like organization. It wasn't a true turnkey asset management platform. We had one investment strategy, but we were building this tight package of TAMP-like services around it and teaching advisors to do what we were doing, which was predominantly factor investing, index investing. We were using DFA, Vanguard, and we were, I think, early adopters of Dimensional, and they're obviously a big partner of ours today. And so we went from being a financial planning shop direct to the consumer to being an asset management, third-party asset manager on platforms like Envestnet, a number of platforms, broker-dealer platforms. It wasn't until about 2013, 2014, we had never given up our individual clients from the early years because they helped us get where we were. People had told us, get rid of your clients, but we never did that. We were never going to do that. We were loyal to them. And so we started thinking, we had hired a young man, Jason Gentile, out of Merrill Lynch in Hartford to run our book as we grew Symmetry. And he did a good job. And that business became a business within unto itself within Symmetry. And we decided that it would make sense to spin it out into its own RIA, separate from Symmetry, common ownership. My partner and I still own them both, but it made perfect sense. The RIA market was getting really hot around 2015, 2016. Yep. And we just thought it made sense. And so we spun it out to its own firm. My partner and I ponied up some money. We made some acquisitions, and we quickly built it up to about $2 billion on its own. And then we brought in a minority partner and Wealth Partners Capital.
So cool. It triggered in my mind. I remember you talked about the RIA market being hot in like the 2016. I remember being at a Schwab Impact conference and them putting up some of the numbers around like the speed of people going independent and what the RIA channel looked like. And I just remember being completely staggered at, how many firms were going independent, what the growth of the RIA channel looked like. I mean, it really felt like that was sort of this catalyst of what we're seeing now. It's crazy. Somebody said on one of these recently too, I'm curious to hear your thoughts on this, but back then, like $1 billion RIA was like something really notable. And now I feel like $1 billion RIA is really like a $5 billion RIA or whatever. I mean, everybody's just grown so much.
I'd agree.
It's crazy. So I didn't know that. Thank you for sharing that story. I thought they were kind of, totally separate endeavors, but it's cool how it all kind of was born out of each other. Isn't that how the greatest businesses start? Is you're kind of going down one path and you're like, there's another opportunity here, which is
exactly,
which is cool. So you all just recently had 3 internal promotions to C-level positions. And that's not common. I mean, a lot of people will go and hire from outside, go find somebody who's done it or whatever. Not completely unheard of, but not very common. So for you, is that something you strive for? Is that part of the culture, is to try and promote from within, or is that, rare for you? Or how do you think about that?
That is definitely part of the culture. It was natural for me. 3 of the 2 hires to the C-suite have been with me nearly 20 years, Meg Martin and Jason Gentile. They've been with me a long time. Number one, when you have a company culture, hiring from within maintains that culture. When you hire from outside the company, there's nothing wrong with doing that. There's 2 things you have to take into consideration. Their capability of doing the job, fine, but then will they fit in your culture? Just the logical first place for me to look was the people that I had and talk to them about. Number one, do they want this? Do they want the more responsibility? Do they want to take on a bigger job than they were doing? And then number two, can we arrive at what is a fair package for them? Because I want to see them all benefit the benefits that I've had, which is the benefits of ownership. So we created a profits interest program immediately at Apella, and the C-suite have all become owners of the company. Our president, Jim Scanlon, as well. We've promoted from within. Our CFO position, Jason Shook, while he is new to the firm, Jason was in the finance department of a large RIA for 15 years prior to coming to us. So also very experienced in the RIA space. It was an independent RIA. And so he was an easy transition. So that whole C-suite that we've built out here, I think is what certainly the large RIAs have been doing and what the up and coming RIAs are going to have to face. You alluded to $1 billion RIA earlier. We're just around $5 billion right now at Apella. As you start this march from 500 million to $1 billion, you have to consider professional managers. It can't be advisors who are partners wearing 2 or 3 hats. You can do that when you first start out. I did it with my partner. But when you get to a certain size, I don't know what the magic number is, you have to have some people whose sole job is focused on IT, on operations, on finance, et cetera. So that's what we did. We made that commitment. And I think promoting from within should be the first place you look, really.
That's so cool. I think that's a refreshing perspective. I think it's cool to see people. I mean, even to hear you say too that people have been with you for 20 years. That's not super common in our world anymore either, because most people feel like the only way to really grow or increase their pay or comp or anything is you got to jump to a different place and kind of change your ladder every couple of years. So you must have built something where people want to stay loyal.
It works both ways. I've had some people that were with me for a long time. One of my bosses told me a long time ago, hey, if I received a job offer from another firm and I went to my boss and I told him before I had made a decision, I just felt fiercely loyal to him. And he said, well, you know what that means? It means I'm doing my job, that you're doing well. I had something to do with that and somebody else is recognizing that. So I've had some employees, the current chief investment officer of Investnet, Dana Dioria, worked for me for 14 years.
Wow.
She's a dear friend. She still is to this day. And I had that same conversation with her that my boss had with me. She came to me and I said, you've received a great offer. It's a great step in your career. I wouldn't blame you if you took that step. And I've had a couple of employees over the years do that. It's bittersweet to watch an employee leave, but it feels good that they're leaving for a great opportunity. I prefer they stay. And you want to do everything you can to incent them to stay. And I think the best tool we have after providing a great place to work, a great culture, after all that is said and done, you want to give them the benefits of ownership, because that's where real wealth comes from and security comes from.
Well said. So my notes also said, which I guess this makes sense a little bit, but you all created a residency program, I guess probably to help with promoting within or with helping people. But when I hear residency program, I think of like the medical field. Is that where that's inspired from?
Exactly. So I can't give you a fully detailed history of it. I'm with you. When we acquire a partner firm, we look at them top to bottom to see what they're doing well, because oftentimes you're going to put them onto your tech stack. You're going to put them onto certain platforms that you have. We're a national firm, and the firms that we've acquired come under our name, come under our tech stack, come under our philosophy. We can talk about that in a moment. Yep. But to your question, one of the firms that we acquired out in Huntington Beach, California, run by Evelyn Zolan, who's been in the business a number of years, well-respected advisor. Evelyn came up with the idea. She and her husband, Mark, came up with the idea of bringing on young potential advisors, prospective advisors, and giving them a 3-year residency to train them and have them work at the firm. Everybody knows that at the end of that 3 years, they may or may not receive an offer. If they're doing a great job and the firm has the ability to, they'll make them an offer. And Evelyn did this, for a few years before she joined Apella. And when she joined Apella, that was one of the things we loved. We had already had a similar program on Apella, but it wasn't as well defined as hers. So we kind of took the two, put them together using mostly the ideas that she and her team had come up with. So now we have young college graduates. What's different now also, and you're probably aware of this, is colleges now are providing degrees in financial planning. These young people can sit for the CFP exam right after graduation, which I think is wonderful, right? So we're getting these young CFPs right out of school, and they'll spend time with the paraplanners, they'll spend time with portfolio analysts, they'll spend time with client service folks. And they get this nice, well-rounded view of our business. And then they start sitting in on meetings with the senior advisors. They start interacting with clients. And by the end of the residency, they're ready to take on their own clients. And we have this nice organic way of helping them start in the business, which people like me certainly never had, and I'm sure most of your guests never had. We had to go build it ourselves. Now we have advisors who will be thinking about retiring or thinking about at least culling some of their client base so that they have more free time. And we have young, experienced advisors who can start talking to those folks, and they can start building their business with clients that have already been with the firm for a number of years.
It's so unique. For some reason, this has become a topic I've become relatively passionate about, but it's about, onboarding people into the industry now in a way that, there's so many different ways to do it. Whereas like you're talking about the early days of this industry, it was like, here's a phone book, go see if you can find some clients. If you can't find clients, then go find another job, right? You were either an advisor who could rainmake, or you were a back office employee. And those were your only two options in this space. And it seems like people have created all kinds of different ones. What's unique to me about this residency program is, I've heard of the diamond team approach or the junior advisor approach or things like that. It sounds like, this is empowering people with a little bit more responsibility, the same way that a resident would in a hospital. I mean, they're real doctors, they're doing real doctor work, but they're still under the tutelage of someone who, is experienced and is guiding them and is helping them. And I just think what a great way to onboard people into providing meaningful advice, because you're not completely thrown out to the wolves and saying, hey, go figure it out. But also you do get to run with some stuff there and actually be a real advisor and on real accounts and doing real planning. So that's a very unique approach.
Thanks. We love it.
All right. So you mentioned some acquisitions. Obviously that's a part of the Apella story. You also talked about how you guys have taken the approach where it's the Apella brand, right? So this is not the approach of, we're trying to aggregate up AUM, let you keep your brand, let you keep everything, but you're just going to hang under our thing. You're saying, no, like we believe that the way we provide advice, the way we do things is I don't want to call it the right way, but this is the way we found to be successful. You're going to use our technology. You're going to use our brand. You're going to use all of that type of stuff. Did you try like the fully open architecture thing and then end up with we're going to do it all the Apella way? Or was it from day one, anybody who comes under this Apella brand, Apella tech stack, Apella everything?
It was the latter. So I think a lot of the early roll-ups, they left a sour taste in my mouth, and not because they do something wrong, but they were private equity driven shops that were doing what I would call, a lot of balance sheet management, and that was their focus. I'm not criticizing that. I'm not smart enough to do that. That's not my background. I've got smart people here with an M&A background, but I'm not able to do that. So what came to me and my partner naturally was, well, we're gonna build an RIA the way we want to build an RIA. And I think the easiest way, quite frankly, to do that is to look for like-minded advisors. So every partner firm that we've acquired came out of the DFA, Vanguard, evidence-based approach to investing. And that was number one. And number two, and equally as important, they're all financial planners. I think that we always talk in this business about how do you differentiate yourself? People think on this, and you don't have to think long and hard on it. You differentiate yourself by delivering more services that are important to clients. If you're just an asset manager in the retail space, I think you're a dinosaur. You have to be offering financial planning. You have to get really good at it. It's difficult to do the right way, we feel. So in-depth financial planning. And then from there, you can start offering other services like we're doing with tax planning and intergenerational wealth transfer planning, estate planning. All these things are what I think most successful firms of the future will be offering to clients, headed up by a seasoned advisor who's backed by a team, not an individual who's trying to do it all themselves.
Good point. Yeah, there's a lot of directions I want to go on this. I think one thing that pops into my mind, though, that I'm just curious about, I don't think I've asked anybody this, but I totally agree with you that the RIA of the present and the future is going to have to do more sophisticated and complex planning. I mean, that to me makes sense. But I also am contrasting that with, our world. It's like people's attention spans are shorter, their ability to do stuff. So I guess my question for you is, the desire for an RIA is to do very deep, comprehensive, complex planning. But is it easy to get clients to come alongside and participate in that? Or are they having to do it in chunks? Or like, how do you have success in actually delivering comprehensive planning to a world that is kind of so distracted and busy and, there's just stuff going on all the time?
That's a great question. And so my voice in the firm is that of the financial advisor. But to be clear, I haven't been a financial advisor direct to clients for a number of years now, but I thoroughly enjoyed it. And I sit and meet with our financial planners on a regular basis. So those are my people. To answer that question, I think for the two parts to it that come to my mind. Number one, you as a financial advisor have to understand how to work with your client. All those things you just said are very insightful, and you have to recognize them in your client. How can I get this client to be successful working with me? So what I used to think is what I used to even say to certain prospects and certain clients, and if I didn't say it to them, I did it. I'm going to teach you how to be a good client. I'm going to teach you what to do, how to act, so you're a successful client. And if I can't do that, you shouldn't be a client. It's not a good match. You have to learn how to turn people away. I learned that a long time ago. So that's number one. Number two, and this is as old as the business, but the most successful advisors, they have a niche, they understand their niche, and when the prospect sits in front of them, they very quickly come to realize, this is my person, this is my advisor, because they know everything there is to know about me already. While everybody likes to think they're unique and they're an individual, and they are, if they are part of a particular niche, single women head of household, airline captains, doctors, etc., any financial advisor will tell you, well, I start seeing similarities because they come to me with the same issues. They come to me with the same concerns. So I'm generalizing, but I think that's a truism. So to answer your question, understand your niche and be able to train your clients to be good clients. And after that, what I've seen in this business that has accelerated dramatically in the last 20 years and continues to accelerate is adopting technology to help the advisor do exactly what you just said. How do I keep people engaged with short attention spans? So many of our advisors do their meetings like this, via Zoom, via Teams, etc. Our tech stack is very compatible with how we not only manage money, but how we plan. So we're on eMoney for financial planning. A lot of that is done on the screen. The plan will be handled largely by the paraplanner, and then the advisor and the paraplanner will put together from that plan what they think the client is interested in seeing at that next meeting. And you can change these things on the fly, on the screen. You can make assumptions on the fly. It's all very interactive. It's all very in the moment. So you have to be doing all those things to keep the client engaged. We're having, knock wood, we're having tremendous success doing it. So there's a lot of young people here, a lot smarter than I am, that know how to use the technology, leverage the technology, and keep the clients engaged.
This podcast is brought to you by Turncast. We make game-changing content for fintech and financial services companies. Learn more at turncast.com.
I've been around thousands of advisors probably now at this point. And, everybody loves to talk about planning and stuff. But the ones that always kind of catch my ear, the ones that I find interesting are the ones who really do know stuff about their clients. Like I live in Atlanta, Georgia, and I met this guy one time. It's like he knew everything about the Delta's pilot union. He knew everything about how their comp worked. He knew comp better than the pilots did because he's like, this is just all I do, right? It's like I only serve Delta pilot. I don't serve United pilots. I don't serve Southwest pilots. But it's like if you're a Delta pilot, like you're saying, you're going to find out real quick that I'm the advisor for you. And I'm like, that's really interesting because that to me is truly comprehensive planning because you have to understand all that. So that's well stated. Yeah, it'd be remiss if we didn't talk about technology a little bit. So obviously using technology to make a firm more efficient is table stakes. I think everybody's doing that today. But when you're making as many acquisitions as Apella has, and you've got PE backed and everything like that, I'm always interested in what the technology looks like, especially in your scenario where you're putting everybody on the same. So you are doing conversions. When a firm decides to come to Apella and maybe they're using something different, it's like, all right, we're gonna go through the pain and the root canal of converting everything onto this one thing and whatever. So talk to me about the technology stack that you all have chosen. You said eMoney, obviously, but what have you chosen that has kind of made you successful in all of that?
Well, before I give you the actual tech stack, I will tell you that you hit on probably the largest pain point, which is a conversion of accounts, conversion to tech. A lot of advisors out there would like to acquire another advisor. And my advice to them would be you need to have people dedicated to do conversions, and they have to have serious bandwidth, serious industry experience, knowledge. That's the toughest part. So we have just that, headed up by our Chief Operating Officer, Meg Martin, who is one of the best in the industry, easily. So our tech stack, we run on Orion. And Orion and eMoney, our CRM is Salesforce. Well, all of those providers, they're all quality providers, but those firms have created tech that is extremely robust, and I think from our side of the table requires people that work on it full time. So I think one of the issues that advisors, emerging advisors, let's call them 2, 3, 4, 500 million in assets under management, one of the challenges they're facing is they know that this technology is good. Some of them have made the leap and they're on it, but then they realize I'm using 20% of his capability, 30% of his maybe.
Yeah.
And in their defense, you need 1, 2, 3, 4 people full time. If you're going to become a power user of Salesforce or Orion, you need multiple bodies on that stuff all the time. And I know that's why a number of the firms that have joined us, they reached that inflection point. The advisor typically was a rainmaker who founded it, grew it, did a wonderful job growing it, and they got to a point of, I'm not spending a lot of time in front of clients, focusing a lot on tech, and I don't know that that's what I want to do for the next several years. And I totally get that. So our tech stack is similar to other large firms, but we have a lot of smart people that's all they do full time is work on that technology. And that's the whole point, I think, of the rapid growth in the IRA space right now is the smaller emerging RIAs come to that inflection point. Do I want to create an enterprise, or do I want to join a larger organization where I can go back and focus on being an advisor? And if they choose the latter, should free up their time dramatically to focus on acquiring maybe larger clients or maybe getting a little more work-life balance in their life. But they don't have to focus on all these things that require the attention when you get to that size.
That's so good. You answered my follow-up question in your answer, because I was going to say, a lot of times people have technology that most other people might already have, or something, that's unique there. And it's like, well, is technology really a reason for me to come join? But I love how you said, like, hey, it's not just having the technology, because we see this every day at Milemarker, right? Every single day, somebody has Orion or something like that. And it's like, they're like, I feel like I need a PhD to understand how to use all of this stuff. And we just hold such a deep belief that advisors should not be messing around in Orion, understanding all of the features. It's like, you should be out providing advice, creating advice, delivering advice. Let somebody else run the technology stuff for you and serve you as the advisor with it. I mean, we're really, really big believers in that. So
100%. I will tell you that, and this is, I'm 62, I'll be 63 in a week. So this sounds like an old man in the business, shouting at the world. It's not what it's meant to be. But I will tell you that this is still a relationship business. I remember when the first, robo advisors came out. I'm like, this is no way they're going to replace face-to-face, even if it's over a screen, face-to-face advice when it comes to people's life savings. It may one day. AI may one day take over this industry. I don't pretend to know what the next 50 years holds. But I still see that people want a relationship in place with someone they trust. And technology is there for us to leverage and use to make us more effective at what we do.
100%. I love that. All right. So let's also talk about one of the big things of successful firms that are acquiring or rolling up firms is, I love the fork in the road you talked about is you kind of decide, do I want to become an enterprise or do I want to join an enterprise? And I have found that the enterprises that successful firms want to join are the ones that have kind of figured out organic growth. Hey, I'm going to come in here because you're going to help me grow my firm with what you're doing. You guys have a great podcast as well. What is it? It's Talking Real Money. You've done organic growth stuff and everything like that. I mean, it seems like that's been a huge challenge for a lot of people, is figuring out how to crack this organic growth code. What have you guys done right? What have you figured out there?
Great question. Well, I'll tell you, first of all, it's focus, right? So when you have clients referring business to you, when you have a stock market that's been going up, you can turn around and say, oh, look, we grew X amount, and you didn't have to do a heck of a lot. So I don't think there's a lot of focus on organic growth in our industry. The numbers I've read, maybe you've seen them, Kyle, are 1% to 2% for RIAs, real net new asset organic growth. And I have a very different belief. We're not a roll-up shop, as I said earlier. We're acquisitive, but only for like-minded advisors. And that is definitely a type of business that has its ups and downs. When money's cheap, or when times are like this that we're in now, where there's just a land grab, there's a lot of M&A activity. That's not always going to be the case. And so there should be at least an equal, if not a greater focus on organic growth, which will sustain you through leaner years. We have a head of marketing here, full-time head of marketing, and she has 2 or 3 folks around the country working for her in concert with the advisors to come up with marketing plans for each advisor. Our net new asset organic growth has been between 9 and 11% per annum for the last 3 years, which is exceptional. It's a tribute to those folks. And we also have, as you alluded to, do you remember the Tappet brothers, Click and Clack on NPR radio?
Yes.
The car guys, they were called.
Yep.
And for some of your older viewers, they'll remember those guys. They were wonderful. We have that in the form of Tom Cock and Don McDonald, who have been around for a long time. They actually had radio experience before they were financial advisors, and especially Don. And they had a radio show in the Northwest, in the Seattle area, that was quite successful. And when we met them, and we talked to them I think we talked to them for almost 2 years before they decided to join. And they were already investigating, I believe they were already investigating podcasting. And so what we were able to do was, just because of our size and our scale, we were able to support them and give them the resources they needed to grow the podcast dramatically. They do all the work. They are outstanding at what they do. They have a very loyal audience. It's very personality driven, in addition to obviously giving good information to investors. I've been to Retire Meet, which is an annual event. It's going to become twice a year now that we put on. They were doing it when we acquired them. And they put about 1,000 people in the room virtually and 600 or 700 in person every time they do this. And it's a 100% educational event. So I think we were able to acquire the technology, the podcast and the radio show. Then through technology, we were able to increase their audience. It's been a wonderful way for us to get our message out on what we believe in, what we practice to people. And they're national now in their listenership, and we're national. We have 17 offices across the country. So listeners to their podcast will generate, a prospective client for our advisor in Knoxville. So it's great.
That's such a huge advantage of the marriage there of a podcast, but, being married with a national office. We have some friends that have an incredibly successful podcast. I mean, it's unbelievable, but they've only got one office in the Southeast, right? So it's like, if you've got listeners all over, you can do Zoom and you can do all of that type of stuff. But sometimes it's great to be able to go, oh, there's an office in your city. You can go see them there. And that's like such a great collaboration and cohesion there.
Yeah.
Symmetry, if you will. So, all right. We're starting to kind of come to the end here, but I've got a couple more questions for you before we jump in. But I'm pretty impressed by how well you knew your numbers off the top of your head there. I think that's a good trait of all CEOs, is they should know their numbers. So you're able to rattle off net new asset flows and things like that. But one thing I've found in this space, and it's one of the reasons why Milemarker exists, is that it's very difficult for owners of RIAs and for C-level executives to gather numbers like this, right? Is that actually my net new flows? Are those, is that actually how profitable we are? What's our revenue supposed to look like? All of these things. So, and I know you have financial partners as well who are always hungry for that stuff, right? So, hey, tell me how the 17 offices are performing. Are any of them performing better than others? Like, how are we? So Pat, how are you guys getting the data and slicing and dicing that to be able to be so good with your numbers and to make that happen?
Well, I think I'm going to leave you a little short on this because I rely on having really, really smart people around me. I think any CEO who's doing a decent job has a slew of people behind them who do a great job. So obviously, the Orion platform provides us with the bulk of our data, financial data. We've been power users of Orion for a long, long time. And then I have a very experienced CFO in Jason Shook, who's been in this business for a long time, and Jim Scanlon, our president, who has an M&A background, who's also excellent financials. So you build a team where the areas of expertise complement each other. I represent the advisor's voice in our management meetings. Jim Scanlon understands M&A and is the lead on all of our merger and acquisition discussions. We did most of them in-house. Wealth Partners Capital is a minority investor in the firm. They've been an outstanding partner, and they provide us with support in M&A as well as legal. So I have to tell you that data, where it comes from, largely the financial data comes from Orion. Our client data comes out of Salesforce. And after that, planning all comes out of eMoney. And then we have some bolt-ons to all of these, like Holistiplan, that help us do our job. So I think that's about as complete an answer as I can give you on how our data comes to us. But just receiving data feeds from various providers and vendors is one thing. Having the people who understand it and know how to present it. We're very conservative in our forecasts. We're very conservative in how we run the business. We're not highly levered. That terrifies me. I don't ever expect to be that type of firm. I think the one piece of advice I could give to advisors who are looking to do acquisitions would be, don't fall in love with leverage. Go read Taleb, go read The Black Swan. Some really smart people have gone out of business in our industry over the last half a century, and we don't want to be one of them.
Well stated. I appreciate you sharing that. Very, very good. So 2 final questions for you. Segments really. So the one segment we love to do is I ask you to get out your crystal ball and tell us what you kind of see coming. So you mentioned a couple different things about, what you think might stay the same in this industry and whatever, but tell us what you think is going to change. What do you think the future looks like as you look down the road?
I'll never doubt the ability for the sole proprietor who's driven and passionate to be successful. And I root for them. But it's going to be tougher to do that in the RIA space as technology becomes more and more the rock that we all need to lean on to get the job done. So I think consolidation will continue for years to come in the RIA space. I think that the offering of the RIAs will continue to grow and become more robust. You have to be a financial planner, I think, to survive in the business in the next 10 years. You can't just be picking mutual funds or picking stocks. I think those days are gone. In addition to tax prep and maybe estate planning, I do think intergenerational wealth transfer is going to be huge. And you have to have the expertise of a really deep financial planner, CFP, as well as an estate planning attorney available to you to handle the wealth transfer. The boomers are going to transfer somewhere between 50 and 80 trillion of the numbers that I've read to millennials and Gen X. And in order to do that in a tax efficient way, in order to do it in a way where the parents, the people who are transferring the wealth, feel good about it, and for the children of those parents not to blow it, is going to take serious planning. I will tell you that, Kyle, when I talk to folks who have done well, and I'm not talking about ultra high net worth, right? I'm talking about people who've done well. Their biggest concern, by and large, is what's this money going to do to my kids? It used to be, am I saving enough for retirement? It used to be, this, that, or the other thing. That question now is what we hear most often from people who have done well. And we have to be prepared to answer that, to coach the second generation how to receive the money, and to coach the parents how to interact with their children about the money. There's a lot going on there. So I think that's going to be huge in our business. And technology, obviously, is going to continue to be incorporating AI into what we do without it watering down what we do. The authenticity of what we do is going to be very important.
Well stated, man. I love it. All right, we are going to move into the final segment of the show. We call this the Milemarker Minute. So it's kind of like a series of lightning round questions intended to be a little bit more lighthearted and fun for us to help people get to know you a little bit better and keep going from there. So you ready for the Milemarker Minute?
Let's do it.
All right. So we stated in the beginning of the show that you are a frustrated golfer. How often do you get to be frustrated per week or per month?
I try to play twice a week, sometimes 3, but my joy in life is going to Ireland and Scotland and playing where the game was born. I love it over there. I will never be as good as I want to be. I'm not bad. I'm a little better than average if I believe what other people tell me, but I tend to play with people who are really good because I love watching them play and I aspire to do what they do. The frustration part is knowing I will never be able to do what they do.
I feel that deeply in my soul. So that being said, number one golf course still on your bucket list that you haven't been able to play yet?
That I haven't? Well, I'm a very fortunate man. I've played a lot of great courses. I haven't played Pebble. I haven't played Pebble Beach. My golf trips tend to be over to the UK. So maybe Pebble Beach because it's iconic and I haven't played it. Any golfer who who wants to answer that question will probably put Augusta on their list.
Yeah.
Maybe. I've never played Augusta.
Yeah.
So let's leave it at those two.
Yeah, I love it. The good news is Pebble, pretty easy to get on. Bad news is Augusta, almost impossible to get on.
Exactly.
That's awesome. Kind of staying on that theme where is one place in the world you'd love to travel that you've never traveled to before?
I want to go to Italy. I have a brother, a sister, and a good friend who all came back with the exact same impressions. Go to Italy, spend at least 2 weeks there, and travel the countryside. It's wonderful to go to Rome and Florence, etc. But travel the countryside, drink the local wine, eat at the local trattorias where the food is fresh and the owner is a chef. And they all came back and said the same thing, which I found interesting. So
you gotta listen.
That's my next big trip.
I love it. You've mentioned DFA a couple times in this podcast. The firms that you like to try and target for acquisition, but also is something that's been very successful for you. What is it about DFA firms that makes them so successful? Is it just completely buying into the DFA methodology? Is it something else? But I feel like on average, DFA firms, tend to be a leg above.
Clearly. I'm a good person to ask that question because I've been doing business with them for a long, long time. My first regional director, their wholesalers, he was on the job, I think 2 weeks when he came to see me, was Dave Butler. He's the CEO. So along with Gerard O'Reilly. So I've known these guys for a long time. So I would tell you that the answer is twofold. Number one, many of us are attracted to the academic underpinnings of the research. I think that, the Fama French body of work, all the other PhDs that are affiliated with Dimensional, and lend an air of legitimacy to the work that they do. I went down to the street in 1983. When I first went to the street, there was no such thing as a PhD working at a Wall Street firm. Didn't exist. First one I met was Marty Zweig back in like 88. So it didn't exist. Now every firm under the sun has a relationship with a PhD if they're not outright employees. So that's number one. Number two was the advisor division of Dimensional was really founded by a guy named Dan Wheeler, who is one of my mentors in this business. Dan passed away a couple of years ago. He was a very dear friend, and he changed the way I thought about the client relationship. He really ingrained in me what I was learning on my own. I'm a teacher. I'm an educator. He crystallized it for me because that's how he was as an advisor before he founded the advisor division of DFA. And Dan was instrumental in bringing on some people there or introducing us to some people. So David Booth and Rex Singfield brought on people like Gene Fama and Ken French. Dan introduced those people to retail advisors. And so it was an eye-opening experience to listen to these, giants of modern finance talk about it. And then we learned from each other. How do we take these concepts and sit down with mom and pops and explain it to them that the markets work probably differently than you've been told. Let me explain it to you how we see markets. And that was instrumental. So Dan was a huge impact in my life. DFA, I think, is a quality firm. I count David Booth and I count Dave Butler as friends. I owe them a great deal.
Wow. Okay. That I got way more out of that question than I expected to. So I appreciate that. Now I think that's a great place to wrap up too. So Pat, this was like a really fun conversation. I enjoyed learning about the story of your firms and how you think about the industry. And I can tell you're a teacher because I could, it's coming across even in the way that you're sharing these answers and the way that you're trying to educate the audience and me. So much appreciated. I say to a lot of people, time is a gift. And I'm very thankful that you'd be willing to gift some of your time to us today on the Connected Advisor.
Well, happy to do it, Kyle. Thanks very much. It was a great interview. I had a lot of fun.
Thank you, sir. All right, everybody, that's been another episode of the Connected Advisor. Please make sure you click follow or subscribe wherever you're listening to this. And if you'd be kind enough, leave us a review. Apparently, that really helps with people finding this so that they can hear the great interview with Pat. So that would be very kind of you if you could do that, especially if it's 5 stars. If you're going to leave a 1-star review, don't do that. Just kidding. You can leave whatever type of review you want. But make sure you click follow or subscribe so we catch you on the next one. But until then, have a great week.